All right, so how the hell do you make money in the markets when the markets are going down? 2022, markets have been going down. I talk about often how I'm still up for the year because of the ability to trade the markets both up and down, to make money up and down. And people have been asking, like, okay, what's the big secret, Brad? How the hell do you make money when the markets go down? That's what I want to talk about in this video. And I want to talk about it in terms of options. You can, quote, short the market, but I think to basic retail investors, shorting the market is not what you think it is. All right, you definitely have a misconception if you don't know what shorting the market is, and maybe that could be a completely different video. Maybe leave in the comments if you want me to talk about shorting a stock and how people do that. You need a specific broker to short. You need a margin account. There's a lot of things that general retail investors like us can't do to short the market, or aka bet against the market going down. But there are things that we can do as simple retail Momo jabroni investors to make money while the market is going down. And these are inputs. And I just got off an awesome call with Tom, and Tom was asking, like, what's the difference between selling a put? Like, when do we want to sell a put to make money when the markets are going down? And when do we want to buy puts? Because there are two completely different strategies, right? Buying puts and selling puts are completely different strategies. I will link a video down in, like, I'll pin it in the comments of the difference between buying and selling a put. But, like, let's put this to action. Let's talk about when we want to sell a put versus when we want to buy a put. And it's often debated that buying options is way more risky than selling options. I think I used to somewhat agree with that. I think it's just generally easier and better to tell people that they both come with inherent risks, okay? The good thing about buying an option is you know what your loss is going to be. It has a defined loss. The premium that you pay when you buy an option is the most money that you can lose, right? You know, all right, I just spent $1,000 for this options contract. If it goes worthless, I'm going to lose $1,000. That is not the case when you sell an option. You can get losses all the way down to the stock price going to zero. Not a lot of people talk about that because how many stock prices are really going down to zero besides Peloton? And so it doesn't happen very often, right? We don't have these go to zero and you lose all your money. But I like to buy puts because I know exactly how much I can lose. But I like to sell puts because I collect premiums from the buyers, which is like, it's passive income. We've been talking about that for a while. So when am I buying and when am I selling puts? Let's start with the sell side because I think from a framework, it's a lot easier to understand. There's less variables, less nuance, okay? It's very cut and dry when I am going to sell a put. I am going to sell a put when I want to own 100 shares of a company at a specific price that we call the strike price. And I can make that expiration for however long I want. The further out I'm going to go, the more money that I'm going to have to make, but I'm going to have to tie up my collateral because when you sell a put, you need collateral. That's why they call it a cash secure put. You could do it with margin. That's not how I like to do things. This is not a margin channel, but you can do it on margin, but I like the cash secure put, which means that I have the money in my buying power to buy the 100 shares right there and then at that strike price if I am assigned. Brokerages love that. You don't need margin, and it's just the money gets set aside as your collateral, right? When we write a covered call, 100 shares is our collateral. When we write a cash secure put, I say write, that means sell. When we write a cash secure put, that means that we have to put that money aside so that if we are assigned, an option does not expire worthless, which is our goal, we will have to buy those 100 shares. And the buying 100 shares is what makes that a little different than when I buy a put, right? Because when I sell a put and I know that if I get assigned, I'm gonna have to buy 100 shares, right? I'm only going to do cash secure puts with companies that the end goal I know might be that I'm going to own 100 shares. And I might have to bag hold. Right now, Peloton. Once again, I'll say Peloton as many times. Let's make this a drinking game. Every time I say Peloton, everyone's got to take a sip. Peloton right now, I got assigned on a cash secure put at $40, and right now it's trading for like 10, 12. I don't even know. It's so bad. I was willing to hold Peloton. I wasn't expecting to bag hold it this bad, but I had to buy 100 shares at that strike price. And I had to know that one of the consequences of selling was that I was going to own 100 shares. So you do not want to be selling puts if you don't want to own shares of the company. How do you make money, right? The markets are going down. How does this make you money? Well, when you sell a cash or put on a red day, premiums are higher. So you are going to make money while the market's going down, collecting higher premiums as the share price is going down, right? We like to write covered calls on green days, and we like to write cash or puts on red days. So I'm going to make money as the stock is going down. I'm going to be writing cash or puts below the current share price, collecting a premium and hoping that the share price stays above that strike. The option expires worthless, and that's that. And if this vocabulary is a little bit too much and you have no idea what I'm talking about, I will also pin in the comments like I said, what is a cash or put? What is a covered call? I'll leave everything you need to know, and then you can come back to this. But on the way down, we are going to make money first by collecting premium. The second way we are going to make money is we are going to be buying those shares at a discount to the future. Do I know how long the market's going to go down for? No. We could be red this year, next year, another week, another month. Anybody tells you that they know the answer to that question is lying to your face, and they're probably trying to sell you something. Nobody knows. Okay? But if you believe in statistics and data, you know that over time, years, decades, the market probably is going to go up in one way, shape, or form if you are buying quality companies that are going to be around in decades. So right now, say that this stock is trading for $40 and you're like, it's still a little expensive for my blood. It's still a little overvalued. But man, if it was ever $20, I would scoop up 100 shares. Boom, you write that strike for $20, collect the premium, you just made money in this down market. Then if it doesn't go to 20, you rinse and repeat every week, every month, whenever your expiration is. But if it gets down to 20, you made the premium, and now you have 100 shares of a stock at the value that you wanted, and now it is going to grow, and you're going to make money on the rebound, getting capital gains. So that's how you make money when you sell a cash or put, the premium and getting the stocks at a value discount. Now, on the contrary to that, when I buy a put, this is really what I'm day trading, swing trading, and doing even leaps with. To be honest, actually, let me take that back. I don't really do leaps on the put side. I love leaps on the call side. It's hard for me to bet long-term down against the market. But swing trading and day trading, I love buying puts. They're different than the cash secure put because I have no intention of ever owning the shares of the asset that I'm buying the puts on. When you buy an option, your goal is to sell that option back before expiration. We never exercise options. You're setting money on fire. I'll pin that link down in the comments. We never exercise early, and we really never ever get to expiration because theta, one of the Greeks, is going to dominate us. So when we are getting into an option, we have one goal: sell that contract back for more money than we bought it for. When we buy a contract, we give premium to the seller that we just talked about. Say it's $1,000. I want the share price to go down, which is going to raise the value of the option. Maybe in a week, it's $1,500. Boom, I sell it back. I bought it for $1,000. I sold it for $1,500. Very, very simple economics there. I keep $500 in my pocket, and the share price went down. So I just made money in the red market. And frankly, that's how I've been making most of my money day trading. I just trade the NASDAQ, the QQQ. And if it's down that day, I buy puts. And if it's green that day, I buy calls. I'm never going to own 100 shares of QQQ. I'm never going to exercise the option, nothing. I am trying to make money on the way down by flipping contracts and buying them for less than I can sell them for later. What's the risk in that? Huge risk, right? If it doesn't go down, right, it stays flat or goes up, I lose that option. It expires worthless. That's what the seller wants, right? So when I bought that from the seller, they were saying to themselves, man, I hope the share price at least stays flat or goes up. So it expires worthless. I keep my premium. I can rinse and repeat. Me, the buyer, I'm like, just go down another 2% because that's going to raise the value of my option. I could sell it back and boom, I'll sell it back. And who are you selling it to? You're selling it to somebody that's making a cash secure put and has just the opposite framework, right? The market is a zero wash kind of deal. When you win, somebody else lost. When somebody loses, you win. There is no like, I don't know how else to explain that. So that's how you make money, by buying puts. Some people, they just not ready to buy options contract. It sucks when an options contract goes to zero. I got absolutely eviscerated. I got smacked in January and most of February because I was swing trading and I was buying calls because at this time the market, we were recovering from COVID. I was like, oh my God, markets are going to soar. And I bought 3 to 6 month expirations. Man, I got smacked on Starbucks. I got smacked on Palantir. I got smacked on QQQ. I got smacked on Peloton. All these companies that were going up. Take a sip. I just said Peloton. Everything that was going up. And then what happened in January, February, March? All those expired worthless. I lost like 10 grand. Okay. Now I zoomed out and looked at how much money I had won over the last couple of years. So it wasn't that big of a deal. And right now, all we had to do was switch the mindset. Instead of doing calls, a lot of my trades have just been puts. And that's it. But when you buy options, you have to know more. Like I said, when you sell, it's really as simple as what strike price. What's the price that you want to buy it at, and choose the expiration. That's all you really need to know. When you're buying options, guys, way more risky. You need to think about things like the Greeks and earnings and implied volatilities and expirations, and it's a lot. Which is, like I said, why most people are just going to start with cash secure puts. Like I said, start with the buying versus selling puts video. Get a good handle of that. Hop in the Discord if you want to talk to people that are doing this, doing the wheel strategy and things like that, and you really will understand it. And then once you please don't buy an option until you understand what's going on. Please don't buy an option, right? When you sell an option, the worst that's going to happen is you're going to have to buy 100 shares and you can hold them till it goes up, or you can sell them right back. But when you buy, there's nothing to exchange. At the end of the day, you just lost all your money or you got some, all right? And like I just told you, I got burned and I know what the hell I'm doing. So if you don't know what the hell you're doing, stay far away. You're going to lose all your money and it's not going to be a good thing. But do know that there are ways to make money inside this market. Check out this video right here. It'll show you everything else that you need to know, and I'll catch you guys on the next video.